NVIDIA is once again back at a technically important area, and what makes this setup interesting is not simply the rebound itself, but where that rebound is happening in relation to prior structure, support, and risk. Looking at the two-day chart on April 1st, NVDA closed near 175.75, which is also the level identified as a key actionable zone. On the three-day chart, an earlier signal appeared on March 30th, around 165.1. When two different timeframes begin to align around nearby levels, that usually deserves attention. Not because it guarantees upside, but because it helps define a clearer framework for decision-making. From a technical perspective, the first thing that stands out is the 159 to 175 area. This is the main zone of interest. Why is it important? Because this range acts as a battleground between buyers trying to defend structure and sellers testing whether the recent weakness is the start of something deeper. In other words, it is not just a random price band. It is the area where the market is deciding whether the current pullback is a reset within a broader trend or the early phase of a larger correction. Now, the signal near 165.1 on the three-day chart suggests that longer duration price action had already started showing a reaction before the sharper confirmation at 175.75 on the two-day chart. That sequencing matters. It tells us the market first responded from a lower support region and then attempted to reclaim a higher decision level. For professional chart readers, that often means the stock is trying to transition from defense to recovery. However, recovery is not the same as breakout strength. That distinction is critical. Right now, the market may be pricing in a relief move, but relief moves need follow-through. Without follow-through, they often fade back into the prior range. That is why the next upside area is so important. The 188 to 195 region should be viewed as the primary recovery zone. This is where price would likely face a more serious test. If NVDA pushes into that range, the question is no longer whether a bounce happened. The question becomes whether buyers have enough control to convert the bounce into renewed trend continuation. A clean move toward that band would improve short-term sentiment, but a rejection there would also be normal from a technical standpoint because that zone may attract profit-taking and renewed supply. On the downside, risk management is where this setup becomes professional rather than emotional. The 157 to 154 zone is the risk area that matters most. If price loses that region after entry, the character of the trade changes. At that point, it is no longer about giving the position time. It becomes about protecting capital and removing exposure if the setup is invalidated. This is exactly where disciplined traders separate themselves from reactive traders. They do not argue with the chart. They let the chart define the risk. From a broader view, NVDA remains one of the most watched names in the U.S. market because it sits at the center of the AI narrative, semiconductor leadership, and institutional momentum. But even the strongest stocks move through phases: expansion, correction, stabilization, and then either recovery or breakdown. Based on these charts, NVDA appears to be in that stabilization to recovery transition zone, not yet fully out of danger, but clearly at a level where structure matters. So the clean read here is this. 165.1 was an early higher time frame alert. 175.75 is the more immediate confirmation level. 159 to 175 is the active decision zone. 188 to 195 is the recovery target band. And 157 to 154 is the line where risk management takes priority. This is not about hype. It is about structure, location, and discipline. And for now, NVDA is sitting in one of the most technically meaningful areas on the chart.